Apartment Investing Financial Analysis. I'm Cordell Davenport from SmallApartmentInvestors.com. If you haven't, I suggest to go check out the website. I try to do my best to fill that site with a lot of information that can help myself as well as others be more successful in apartment investing. So check it out. All right. So in this presentation, I'm going to talk about financial analysis. And here are the things that you need to try to get from a seller. One is the income statement, and this is also known as the annual property operating data, APOD. 2, you need a balance sheet, and 3, you need a rent roll. Now, here is an example of a balance sheet and a rent roll. You want to try to get the last 2 of the historical operating statements. This will help you to evaluate the performance of the building, and you look at this over an extended period of time. When you do so, you can look at trends, and you can see how it is doing now and in the future, possibly. And so it can be something like looking at rental rates. You can be looking at vacancy rates. Now, getting 2 years of data may not be something the owner wants to do, but at least try to get to 12 months. And in the industry, this is called the T12, the trailing 12-month period. And now this is crucial for you to look at and observe information. And when you look at this, it will help you kind of make an offer. There's some other things you need to look at as well. So you can look at expenses, revenues. So here is an example of a APOD. Now you see it reports the net operating income with a net loss, and it forms the basis to help make decisions. It's a summary. You see earnings for a given period of time, reports on revenues earned, expenses incurred, revenues minus operating expenses. That equals the net operating income, NOI. And that's the most important thing, is an NOI when it comes to the equation of analysis. Okay, so what we got next? The income statement can be divided into 5 categories. All right, let's see. Operating revenues consist of all sources of revenue, such as gross scheduled income, vacancy loss, and other income. Gross scheduled income represents 100% of the potential income in an apartment building. In other words, if the vacancy rate were 0 and all tenants paid 100% of their rent, the rental income for the property will be maxed. Vacancy loss represents the amount of income lost due to unleased or rented units. You have discounts and concessions as well. And then you have people who don't pay. Now, those all fall under the vacancy loss category. And other income includes, you have late fees, application fees, you have like a laundry room, you have a storage, you have vending machines, you pay for parking, and so forth. So here we go. As I was saying, operating revenues, operating expenses, net operating income, debt service, reserve requirements. All right. Another example. So we have operating expenses. They have everything involved. And when you look at administrative expenses, repairs, payroll, utilities, taxes, insurance, there's a lot. But this does not include depreciation expenses or any type of interest on the debt service, which is basically your mortgage. Depreciation and interest are, of course, expenses for tax purposes, but that is something separate. The objective here is to analyze the income statement for valuation purposes. You're not concerned with taxes. That's a whole new story, whole new conversation. Expenses, more information on expenses. So, general and administrative expenses include things like office supplies, and then you have property management fees. Payroll expenses consist of expenses related to those personally they're directly employed by the building. So in California, for example, if it's 16 units and above, you have to have an on-site property manager living on the property. So that's an example of that. But then you may have maintenance, you may have grounds, you have payroll taxes, workman's comp, federal, state, employee taxes. It all depends on how big the apartment building is, too, if you need all that stuff. Payroll expenses should not include any costs for work performed by subcontractors. Now, even though you may furnish all the materials and pay the subcontractor only for labor, 3 types of expenses fall under repair and maintenance. Unit turnover, which is basically when somebody who's in a unit, they move out, and then you prep it for the next person to come in, painting, carpet, whatever it may be. Contract services, security and patrol services, general repairs, and related materials and landscaping services should all be included in repairs and maintenance. Utility expenses consist of all disbursements, like we have related to the department's utility usage as electric, gas, water, sewer, trash, cable, internet, telephone. Taxes and insurance expenses typically include outlays for real estate taxes and insurance premium. So this helps, of course, to ensure that assets such as the building does not have any loss of income from damage from outside forces. Insurance premiums for equipment, boiler equipment, or other machines all fall under this category as well. I talked earlier about the NOI. So this is the formula right here for NOI, net operating income. Very important. It impacts everything. So as you can see, you get this by gross income minus total operating expenses equals the net operating income. NOI is remaining income after all operating expenses have been dispersed. It is also the amount of income available to service any associated debt, that is, to make loan payments. Finally, the NOI, net operating income, is a numerator in the quotient used to calculate the capitalization rate, cap rate. I have a video talking about that too. All right. DSCR, debt service coverage ratio. Take a look at that right there. The other portion of the income statement is debt service, which is mortgage. It is both the principal and interest made on the property. It is the denominator in the quotient used to calculate the debt service coverage. The reserve requirements portion of the income statement is to cover any capital improvements to the apartment building. Banks will often figure out into their calculations a budgeted amount to make necessary capital improvements. The reserve requirement is estimated on an annual basis and is broken down into a per unit figure. Like, for example, 250 per unit. Balance sheet. Now, a balance sheet or statements reports a property's financial position at a specific point in time. It's a snapshot of a specific date, and it's typically month to month. Now, it can be instrumental to provide information about the liquidity on the property. And at times, this is crucial in meeting unexpected short-term obligations. When you examine the debt to equity ratio, for example, it may indicate that the business is ready, highly leveraged, and that no remaining borrowing capacity exists. The balance sheet is also useful in measuring profitability. For example, when you look at the net income through the use of ratios to the owner's equity or to the total assets, returns can be calculated and be used to assess the company's level of profitability relative to other types of businesses. Asset, liability, equity. So the balance sheet, it can be broken down in three categories like you see here. Observe that the two sides of the equation are equal, hence the name balance sheet. They must always be equal. The difference between the two is equity. The assets are owned by the apartment or a business. Current assets are those that are expected to be converted into cash or be used or consumed within a short period of time, generally within 1 year of the operating cycle. Non-current or fixed assets are those whose benefits extend over periods longer than 1 year. As related to an apartment building, current assets include amounts owed but not yet collected. Accounts receivable, for example. Cash, security deposits, prepaid items like insurance premiums and supplies. Fixed assets include items such as equipment, land, buildings, etc. A sample balance sheet. Some more information on here. So, the liabilities of a business are its debts or any claim another business or individual may have against the business. Liabilities can also be classified as current or not current. Current liabilities are those that require the use of current assets or that will be discharged with a relative short period of time, usually 1 year. Non-current or long-term liabilities are those longer than 1 year in duration. Current liabilities include amounts owed to creditors for goods and services. If they're bought on credit, those are accounts payable. Salaries, wages owed to employees, contractors, taxes payable, notes payable. Long-term liabilities include mortgage payable and any kind of secondary financing secured against the property, such as loans for capital improvements or if you lease some type of equipment. Rent roll. All right. So this provides info that is vital for you as a buyer. A good rent roll should provide you with the following data: unit number, tenant's name, type of apartment, scheduled rent of tenant, collected rent of tenant, other income, date of payments, comments section. The art of the rent roll. Most apartments collect rents at the beginning of the month. And looking at the date paid column on the rent roll will quickly tell you whether rents are on average being collected and when they are due. If they are not, this could be a big underlying problem with management. The timely and efficient collection of rents is crucial in meeting your cash flow needs. An effective property manager will require strict enforcement of collections and will be willing to proceed with the eviction process if necessary. When there's poor collection of rents, it may provide you with an opportunity to create value. Remember, the price you pay should reflect the value of the property as it is currently operating, not what it could be if rents were collected. The value is created only after you have acquired the property and made the necessary changes to improve collections. Responsibilities of a property manager. All right. Now, you have a high occupancy rate is usually a sign of good property management. A tight rental market, below market rents, or a combination of the three. A proficient manager will work hard to keep the units fully occupied. A manager knows when a tenant's lease is up, when it's about to expire, how to effectively renew the lease so as not to threaten its tenant, and on how to bring out all the attributes of the apartment building and have a waiting list for prospective tenants in the event of a move out. I have on my website, smallapartmentinvestors.com, some information about if you want to find a good property manager, questions to ask, or if you even want to manage yourself, some tips and tricks. So check out, once again, smallapartmentinvestors.com. Department property management. All right. So the goal is try to get 6 to 12 months of a rent roll from the owner. When you look at the rent roll, you should be able to assess the stability of the property, look at the efficiency of collections, and the occupancy rate. The stability of an apartment building is crucial for the smoothest possible operation. The goal is to have minimal disruption, of course, to have people stay as long as possible. A stable property is also an efficient property. A stable property means there is zero turnover or minimal turnover. So think of the tenants as customers. You want to keep them happy so they stay and continue to pay your mortgage when they pay their rent. Okay, so we have 26 move outs, over 100 units, 26% annual return. Low turnover suggests that tenants are happy and content with their living accommodations. If they were not, they would leave. Likewise, if the turnover rate were high, the property would not be as efficient because higher turnover results in higher make ready costs, which is the turnover cost to get the unit available to be rented out. Higher maintenance costs and advertising costs also have a play in that because that's what you have to do when a tenant moves out. All right. Well, that was it for this presentation. I'm going to try to push out some more down the road. Once again, go ahead, check out the website of smallapartmentinvestors.com. Thank you very much.